Timothy Riddell, Head of Research for Global Market at ANZ, joins us live from Singapore. Timothy, good morning and thank you for joining us. Let's start with the big story, and the big story is the US GDP data. I'm afraid the US GDP data clearly is not telling us the clear signal of where US economy is moving.
Yeah, the data both on the GDP side and the non-farm payrolls, especially on Friday, are showing that we've got an economy that's trying to gain traction. Certain aspects of the economy in the US look like we're getting a recovery, but other sides of it just aren't picking up. And on the payroll data, the disappointment for us was the wages increase is really low. So it may look like an improvement in the market, but it's not having a result in terms of income. Therefore, it's not really having an impact on consumers, who are a huge part of the so we're just not getting the growth traction that we've been looking for the past 4 or 5 months.
Timothy, hi, morning. The bigger problem this morning seems to be China, wherein the PMI has slowed now for a 4th straight month.
Yeah, China's going through a different process in that it's almost having an engineered pullback to uncover some of the uncomfortable aspects of the non-regulated financial sector and avoid excessive growth, leading to either more increases in that unregulated sector of finance, and they're also trying to change some of the environmental impacts of their large growth. So yeah, it's an engineered pullback in growth there. As long as it doesn't become too sustained, then we think that the growth profile will rebound. In fact, we're looking for a cyclical recovery over the next 2-3 months in China. And if that gains traction, another if, then we could be in a scenario of having relatively healthy performance in China for the rest of this current year.
Do you think a new economic cycle has started for India? Do you think India is on a mend and India is going to be one big outperforming market for next couple of quarters?
That's certainly the hope of a lot of investors. One of our big concerns is that a lot of the benefits that have currently been reaped in India are on anticipation of a new market-friendly environment that's going to come through with hopes that it's going to break down perceived barriers to reforms in several sectors of the economy, especially allowing for more investment going forward. If that were to occur, then yes, we could be on for a series of cyclical upturns. One danger that might lead to, though, is that it would start sucking in investments and also impact the current account. If the current account starts to slip back down towards a 5% deficit level, we've seen it recover quite neatly over the last 3 months, then that's going to be a concern. If there's a relaxation on gold imports, that's going to be a concern for us. One aspect that we're very acutely monitoring at the moment is how much has already been priced into an Indian recovery story, and what are the impacts going to be should, even if we get a market-friendly result to the upcoming election, what reaction will be if there is not a swift move forward in the breakdown of bureaucratic obstacles? And I think that there's a danger we don't get the big uptick in cyclical growth that the markets are looking for.
Timothy, what is your sense, though, on gold? Because we've seen some pressure built in the last 1 year. Does it seem like a rally could come back for the bullion?
What we're watching is that there's a shift in who's the largest gold import globally. It was India as the clear largest importer of freely traded gold in the market. With the restrictions that have been put on over the last 12 months on gold imports, that's shifted quite aggressively towards China as the world's largest importer. And last year, China imported in the order of 1,000 metric tons. So it imported a huge amount of gold. We think that's going to pull back a little bit. The data we're watching suggests that Chinese demand is still strong, but not at levels that we saw last year. So unless we get a breakdown on the restrictions or a relaxing of the restrictions of imports in India, then we may be on for a much more range-based trade for gold, with the current level of around about 1,300 not really being that exciting. If we get a slip back down towards 1240, 1250, then it's got a value profile to it. But right here, 1,300, 1,310, I don't feel strongly towards gold. Slip back and a change in profile in India, and we could see a 10% rally coming through in gold.
Timothy, but in general, 2014 is not turning out to be a bad or a poor year for commodities. Coffee, wheat, crude, gold, commodity prices have done rather well this year. The big basic assumption for 2014 was that 2014 will be a tough year for commodities, but that consensus view clearly is getting challenged.
It's fine on those commodities. If you're an iron ore exporter, you're probably not feeling so comfortable. But yeah, on especially the oil complex, it's holding in really well. We've got this dichotomy between what sort of a growth profile are we seeing in China. It's not a pullback that's going to cause any severe impacts on the likes of energy imports. Europe is doing okay. What's happening in the Ukraine, we need to be watching, because that's holding up oil import prices. If that scenario were to soften, then maybe we'd see oil imports or oil prices started to slip as the profile of concerns over oil from Russia would subside. On the grain side, grains are firm. They're looking pretty solid, and they're probably going to stay solid through this year. We need to watch what's happening on the El Nino cycle through the rest of this current year. But grains look okay at the moment, but what we're forecasting is actually a pickup in production in the second half of the year. So maybe the best has been seen on the internationally traded side on grains. Other commodities, especially the bulk metals, I'm a little concerned that they're still going to be on the soft side. So the softness we've seen in iron ore might seem a bit excessive over the last 3 weeks, but I don't really see that bouncing back very strongly.